Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
This is Bloomberg Deals. I'm Matt Miller in for Danny Berger. She's out in Berlin. Let's bring in Bloomberg Tech's Ed Ludlow and senior IPO reporter Bailey Lipschultz because it's a huge week for IPOs. Ed, the president was just asked about taking stakes in AI companies, and we'll see, I guess SpaceX now counts as an AI company, right? In the biggest IPO in world history, start trading on Friday.
Yeah, it's the thesis outlined in the prospectus, and we know, like Sunday night through this morning, there is actually a roadshow happening, even though they kind of priced the IPO early, which is unusual. And a big part of that communication from management at SpaceX and the bankers is like, we're getting going with this orbital data center story. But like the state of play is very clear. This is an oversubscribed IPO. The institutional order book will close at 4 p.m. Eastern, and there are big, basically long-only asset managers that want a big chunk of it, whether they get it or not. We'll find out. It prices Thursday. It will trade Friday.
You made a great point this morning on Bloomberg Open Interest,
sure,
Ed, that all IPOs are oversubscribed. If they're not oversubscribed, the investment bank has done a really poor job. However, we're talking about such a massive amount of money, right? I think Reuters was saying $250 billion in orders.
It would be a 4x multiple.
Will they keep the price at $135?
I mean, dude, this is tricky because so usually when you enter a roadshow, you have a price range and you market it. But I think our understanding, right, is that they very early said 135. The math that it would be a valuation of 1.77 trillion, 1.8 trillion, raising $75 billion. There is every opportunity for them to put it in the ball in the market's court and get the market to talk them into doing a higher price. Like, that's how it works, right?
Yeah, normally that would be the case, but it does seem like the logistics are actually easier with the fixed price, at least some of the bankers I talked to. When you say 135, to Ed's point, 1.77 trillion, you show up, you put in your order, you can kind of reallocate capital that way. There's going to be no surprise when they make the call, whether it's today or tomorrow evening, and say, actually, now it's at 145. That's our expectation.
I'm going to go out on a limb and say, when Anthropic goes public, it'll be massively oversubscribed. And when OpenAI goes public, that will be massively oversubscribed. You want to break that story now, Bailey?
I can't get too far ahead of it, Matt, but no. I mean, to your point, if it's not oversubscribed, it doesn't get done because
we're not even talking about the retail allocation as well, right? Like
30%.
The retail order book stays open through Thursday.
No, actually, I got a notification. Fidelity, it closes at 4 p.m.
Closes at 4 as well. But people are going to be disappointed. And, the backstory is that, there have been times where Elon Musk has talked about those loyal Tesla retail shareholders one day having access to SpaceX. But there's no codified mechanism for that. So, yeah, it's going to be an interesting 24 hours.
Well, they have $25 billion of shares to choose from, so hopefully they get some of that. Ed, thank you very much. Ed Ludlow from Bloomberg Tech. Bailey Lipschultz covers IPOs for us here at Bloomberg News. Let's get now to Super Return, the conference out in Berlin, the biggest private equity conference in the world. And among the issues there, several main concerns for the industry: AI valuation uncertainty, a stalled exit market, geopolitical headwinds, and undeployed, I should say, capital. Our own Danny Berger is at Super Return and spoke with Jeff Perlman, the CEO of Warburg Pincus.
We now live in a world where it seems like there's a new idiosyncratic issue that comes up each year that's going to push back sales. The reality is you just have to continue monetizing the portfolio and not sit there. One of the benefits of being diversified is when one door closes, others tend to open. Last year, Liberation Day happened. You couldn't sell an industrials business. This year, obviously tougher to sell a software business. But investors then pivot to defensive areas. In this case, industrials is now back in favor. Areas like healthcare are in favor. So we want to make sure we're always then selling into the sectors where the light is shining as opposed to maybe the others that kind of enter the darkness.
Do you think then that this period seriously takes a knock on the strategy of being more specialized, of being a sector specialist, just because of what you're talking about? If you mostly invest in software, this year's been tough. Who knows what gets disrupted next? Do you think the model shifts towards less sector specialists and more just diversification across the board?
Sector specialization is fundamentally important. It's how we've built our firm. The difference, though, is we think it needs to be done in a diversified model, right? If you look at what's happened to the industry over time, persistence has fallen away over the last 20 years. The probability, if you're a top quartile private equity fund, that your next fund would be top quartile 20 years ago was more than a 4 in 10 probability. Today it's more like a 1 in 5 probability. And the reason of that is because too many investors forgot about the core principle of diversification. They went single sector, single country, single stage of investment. And the reality is that's not sustainable. The beta can get you in the top quartile, as you've seen maybe even with some of the software folks, but it may equally get you into the bottom quartile.
What about just the agingness of these assets? They've been holding on to assets longer. These companies are getting bigger. Does that also complicate the process of exits?
Yeah. I think size is really important. When I sit at the IC level, one of the most important things I focus on is what is going to be the enterprise value at exit when we look to monetize the investment. And when you look today, I really think we're in the sweet spot of where you want to be in private equity, which is the scaled middle market. Our average total enterprise value at exit is $3 billion. Every credible financial sponsor can buy a $3 billion EV business, but most importantly, strategics, listed strategics, 40, 50, $60 billion market cap strategics, their boards aren't letting them buy 10, 15, $20 billion businesses. It's too transformational. The algorithms will just sell the stock. There's nobody to communicate the message to. Instead, they're being told, look, do the tuck-in, $2, $3, $4, $5 billion acquisition. And for us, the competitive tension between sponsors and strategics is hugely valuable. It's why more than 60% of our exits over the last 4 years have been to strategics. And I think the challenge of this euphoria about the IPO market, opening and coming, you can count on one hand the number of scaled IPOs that can get done for sponsors. And the other part that people tend to forget is most businesses are levered like 7 times in the private market. To get public, you need to be levered more like 3 times. So if you have $500 million, $1 billion of EBITDA, the amount of primary proceeds that you need in your IPO just to delever before the sponsor ever gets $1 back is very hard. And so I think that's what's going to hold back a number of those. It's also why the secondary market continuation funds, too many of those businesses are single-threaded to an IPO, which is highly variable. And that's why, last year alone, 20-25% of the exits were in, single-asset continuation funds.
Surely we can't just keep doing that of having more continuation vehicles, finding, quote-unquote, creative liquidity solutions. Does this industry need the IPO window to open, or should we just stop relying on that as a vehicle for mass exits?
Look, I think the IPO market remains structurally broken, for sponsors. And we have 60% fewer public companies today than we did 10 years ago. It's really driven by passive money. And it's not to say that there aren't going to be any IPOs. There should still be IPOs, but the industry needs to turn over $750+ billion a year. And the amount of sponsor IPOs is less than probably 50 billion, maybe even 25 billion. So it's not a recipe to success. And so the reality is it's not surprising that continuation funds, and we've told this to our investors, that's going to still be a permanent feature of the market going forward. In the same way that LPs have more tools in their toolkit today than they did 10 years ago to get liquidity in funds like ourselves, GPs need more tools in their toolkit today, and continuation funds are certainly going to be one of those.
Okay, are these mega IPOs, are they good for the industry? Are they bad because you're competing for the same institutional capital and they kind of suck all the air out of the room?
When you talk about mega IPOs, are you talking about the big three?
SpaceX, I think,
big three
SpaceX, OpenAI, Anthropic, but really SpaceX.
Look, I think the part of that most aren't talking about, which I think we all need to be mindful of, is when those are going to get early inclusion into the index is going to have to sell a bunch of other stock to go buy something that's very, very large. And you're also going to have active money that also needs to free up capital to buy what is, 3 very, very large IPOs. And so the cascading impact, I think, on what that could do to the trading of a number of other companies, passive money can exacerbate on the way up, but it can equally exacerbate on the way down. And there hasn't been as much talk about that, but I do think it's something we've got to be mindful of and certainly, watch closely as the year goes on.
So it sounds like that just complicates, again, even further the ability of sponsors to use the IPO market to exit. Is that fair?
Yeah, it's not, when we went back, it's been, 8-9 years ago, we really made a conscious decision that if the IPO was going to be a base case for any of our deals, it's not something we wanted to approve and support at the IC level. And I think the fruits of that decision are in the fact that, as I said, over 60% of our exits have been to strategics, and you have to have that competitive tension between, I think, sponsors and strategics. And to do that, I think you need to be in that core kind of section of the middle market where we've been active over, now 6 decades.
By the way, since we're at super term, we should probably talk about the state of the industry itself. And you've mentioned some of the issues for different funds and what they're working through. The idea of consolidation has been talked about for a while. We've seen more of it between, CVC, EQT, take your pick, adding on various asset classes and different managers. Are you expecting some really big consolidation to come down the pike at this moment to try to survive, and for what some has been a difficult run for a few years?
I don't think M&A is a substitute for performance. At the end of the day, in any funds management business, investors, asset managers, you have to deliver performance to your investors. And so is there going to be some M&A for those who maybe don't have a private equity business, they have credit, they have infrastructure? Will they maybe look for a private equity business? Possibly. But this view that somehow a bunch of private equity businesses are going to come together when these are people-oriented businesses, they're human capital businesses, 1 + 1 doesn't necessarily equal 3 in that regard. I think that's probably less likely. What we are seeing is, certainly from the LP community, many of them want to do more with fewer managers. They want more strategic, performance-driven managers. And I think one of the benefits of being an investor-first private partnership is that all we have to do is focus on performance, right? We don't have 35 products. We don't need 35 products. We want to do a handful of things and do them really well for our investors. And I think that is what's going to bring investors back time and time again.
Well, if there are some people on sale, do you ever think about areas that Warburg Pincus that you'd like to beef up, maybe inorganically, that you'd want to do through M&A? Surely now might be an interesting time to do that if people are shopping themselves.
Look, it's a good point. Everything we've done historically has been organic. We've never kind of paid goodwill for a business. We've brought talent into the organization alongside of our own. Never say never. We've gone into strategic adjacencies that we think still leverages this amazing deal engine that we've created over now, we're in our 60th year as a firm. So for us, my sense is we lean kind of more organic. M&A is certainly a possibility, but the truth is what may be cheap is cheap for a reason. And at the end of the day, you want to buy quality. We want to be always viewed as high performance, quality.
That was my colleague Danny Berger alongside Jeff Perlman from Warburg Pincus at Super Return in Berlin. Time now for an alternative view. Apollo and Blackstone have finalized a $35 billion financing package for Anthropic to expand its AI infrastructure, marking one of the biggest private credit deals in history. Joining us now with the latest is Bloomberg's Emily Grafeo. And Emily, this is so fascinating as we talk on the one hand about redemptions and pulling down the gates. On the other hand, we have the biggest private credit deal of all time.
Yeah, that's right. And this is an investment-grade private credit deal. It's something that Mark Rowan has talked about a lot, that they're trying to get more into this. You can see that the rating on the A1 and the A2 tranche of this deal is investment grade. It's backstopped by Broadcom, which is an IG company, which gave it this IG rating. But yeah, it's one of the biggest private credit deals out there, $36 billion. And if you zoom out, it's all because Anthropic needs a ton of money to buy a ton of TPUs to do all of the AI that they basically want to do.
I find it so interesting because Blackstone and Apollo are selling debt to help Anthropic buy Google TPUs, which are made by Broadcom. And Broadcom is then backstopping that debt. So it's the circular financing story alive and well.
It totally is. The deal basically wouldn't have got done, you can pretty much assume, if they didn't have this Broadcom backstop, because again, this is investment grade debt. This is being sold to institutional investors. They want some type of protection here. Broadcom basically had to give this guarantee because if it didn't get done, then they would have missed out on a lot of revenue from a big sale of, $36 billion of chips. So yeah, they basically needed that circularity.
By the way, this is about 1 gigawatt of compute power. And by my rough estimate, that's about 1 million TPUs. We just had a story on Monday that Google is going to have Intel make 3 million TPUs.
Yeah. It's interesting because I feel like a few months ago it was all data centers, and we were talking about all the massive money that needs to be raised to build a data center and make the construction happen to build this. But actually, it's even more expensive to buy the infrastructure that goes inside the data center to actually power the AI. But the deal is fairly similar to the Beignet deal that Meta had participated in just a few months ago.
All right.
This one's even bigger.
All right, it's the biggest. Emily, thanks very much. Emily Grafeo talking to us about the biggest private credit sale in history. By the way, we got a headline for you regarding deals of a completely different cloth. Fraser's Group offers to buy Hugo Boss for $38 a share in cash. Those shares trading for $36.46. That's the euro figure because they trade in Germany. You're looking at the U.S. ADRs here, though, at 890. Up next, the IPO market is booming with a surge in activity thanks to the likes of SpaceX and Anthropic. Our investor committee takes a closer look. This is Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Matt Miller in for Danny Berger today. Let's get to this week's Investor Committee, where we take you into the boardroom debates in real time. Joining us now is Josef Schuster, founder and CEO of IPOX. Schuster and Matt Kennedy, senior strategist at Renaissance Capital. And let me start with a question on the largest IPO in world history. Josef, I'll put it to you. Is this, just your typical IPO in extra large size, or is this an entirely new asset class?
IPOs generally, we think, are definitely an asset class. I mean, SpaceX is a huge deal. It's just one of a series of very large IPOs. We have had those in the past. It just constitutes a cycle in the market whereby, the market is open. The golden age of IPOs is here, and here goes these unique opportunities for investors to jump into the market again.
Matt, what's your take on this company that's going to trade at, 100 times sales? It's not going to make a profit for many years. Is it a flashback to what we saw in the dot-com bubble? Because it's not an NVIDIA.
It is certainly not. I think that, the technology is a decade ahead of the competition. The company has completely reshaped the commercial space economy. It's taken some very big swings, rocket development, global internet. But that price tag, it is very steep. In order for this market cap to make any sense at all, you really need to go out to 2028, 2029, 2030. It looks like they've got a decent track record of success. But, really have to bank on those 2030 numbers. Have you ever seen an IPO like this, Matt? I mean, they've got no range. They came out with just a price. They're going to have immediate retail ownership in that they'll be in the NASDAQ 100 likely within 15 days. They're going to have an amplified weighting, even though they have such a small float and they don't make any money. Does that make sense to you? This deal is completely unprecedented in a number of ways, and I would even say systematically important. I mean, just for the IPO market. For the past couple of years, the IPO market has felt a little bit like Lucy pulling the football away from Charlie Brown just as he goes to kick it. A lot of starts and stops, but now I think there's widespread anticipation that with the biggest IPO of all time, maybe once and for all, we can get the IPO rebound kicked off and see, other names in the pipeline that we've been looking for. Anthropic, OpenAI, a dozen others. Josef, what do you make of, just the sheer size of this is a little bit daunting. And if you look at the biggest IPOs that we've seen go public in the last 5 or 6 years, they don't have a very good track record for the retail investor that buys in the first few days. In fact, the average drawdown from peak to trough of the top 30 IPOs by size is 55%.
Yeah, I think in the short run, fundamentals won't matter for SpaceX. It's going to be totally sentiment driven. We'll be looking for the news flow. Over the long run, we're going to see a big skew. It may be underperforming. The way we approach it is really a broad basket of IPO investing, 100 names. We pull IPO spin-offs, de-SPACs together. SpaceX initially is going to make 1 or 2%, and then we'll see. From an IPO investor's perspective, we see the best returns really in the US domiciled, non-sexy names like a ULS and so forth. And that's, I think, what the message for investors is. Don't really over-focus on SpaceX. Look really for the opportunities in the broader IPO market, just like the way we do it.
I mean, you have essentially pioneered IPO indexing, Josef, but this SpaceX issue is completely different from the other 99, is it not?
It is not that different. We had Saudi Aramco going public with a float of 1.5%. Again, like it's an outgrowth of the equity capital markets, and the IPO activity is reflective of that. It's all good in our opinion. What we will know at the end of the day, 8 out of 10 companies will likely underperform, and there will be these 1 or 2 companies which will do extremely well, and then the rest, some going to be trading with the S&P 500. So investors need to be aware of those issues. I think one issue, obviously, with SpaceX and OpenAI and so forth is going to be this secondary supply coming, which we estimate to be, $1 trillion just to get to the average IPO over time. And I think that's significant. It's a big fee pool for the investment banks, but I think it constitutes a potential risk, especially if the companies won't deliver on their fundamentals.
Matt, Josef makes a great point. We're going to see when lockup periods end another sort of round of forced buying for index investors. How does this work out across the AI spectrum? I mean, we're going to have OpenAI. We're going to have Anthropic. They will also likely be trillion-dollar IPOs that are going to have a component of forced buyers.
Yeah, I think we are going to see that tug of war, the push and pull between the lockups expiring and then the forced buying from the indices. I think that from an investor's perspective, it's probably not a good time to buy on day one your entire position. Best to spread out those purchases over several months. So just to echo what Josef was saying, and really not just own only the big names either. A lot of the smaller deals can really drive performance.
Does it matter? Does it matter, Matt, that they don't make money? I mean, Josef used Aramco as the analog, but Aramco essentially prints cash, whereas this company, OpenAI, Anthropic, they are subsidizing AI usage, which brings with it billions of dollars in losses.
Yeah, I mean, the losses are a lot to stomach. There's no question. I think with SpaceX, you are already seeing some of those gains from the AI capex with the Google deal and the Anthropic deal. But yeah, you have to really believe in the long-term vision of the company and stomach those losses in the near term. And it's not going to be, I could see it not being pretty. But at the same time, I think volatility is kind of the price of admission here.
Josef, I'm curious what kind of rules you would have to include an IPO in your index or in any number of indexes, because an IPO index can inherently not have seasoning, because so many IPOs are companies that don't yet make money or even generate positive free cash flow. Do you need a set of standards to decide what to include and what not to?
So we look at initial returns. This initial pop, I think it's a problem, and it's several 100% or so. We look at float as well, initial market cap. What we find really what matters is a quarterly rebalancing process down the road, and it also matters how long you define an IPO window to last. A lot of fund managers would think the IPO effect is over after 1 or 2 months or 1 or 2 years. we really have pioneered a long-term thinking about IPOs, which is around a 4-year, 5-year presidential cycle kind of window. And if you define this type of long period of time, you have tremendous investment opportunities coming because you deal with large IPOs by default, but also IPOs which can become large over time, like a Tesla. And these are the interesting momentum companies such a strategy actually can get you into.
Absolutely. Matt, let me finally ask you about the scale of these 3 mega IPOs coming to market. Could be $4 trillion in market cap. Can this market handle that kind of liquidity demand?
I think so. Based on what we've seen in private markets, tens of billions of dollars being raised privately. I think if private markets can support it, public markets can too.
All right, thanks very much to both of you. Today's investor committee, I should say, Josef Schuster, founder and CEO of IPOX Schuster, and Matt Kennedy, he's senior strategist over at Renaissance Capital. Up next, more from Super Return in Berlin. We'll hear from Alex Kelly, global co-chair of the M&A and private equity practice at Latham & Watkins. This is Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are extending losses, sitting near a session low in the S&P 500. After President Donald Trump said the U.S. will resume attacking Iran, quote, very hard, renewing concerns that the conflict could drag on. A cooler than expected inflation report offered some relief, but wasn't enough to overcome rising geopolitical tensions. Oil is moving higher, with Brent crude and WTI both trading above $90 a barrel, as traders weigh the risk of disruptions to energy supplies in the Middle East and the Strait of Hormuz. In company news, Devon Energy is heading for its best day in 11 months. That's after raising its full-year production forecast and announcing a portfolio review aimed at sharpening its focus on the Permian Basin. And finally, DraftKings is trading at its highest level since January, after reporting strong growth in its predictions business, with annualized consumer volume reaching $1.3 billion in May. Those are your midday movers. I'm Nora Melinda.
This is Bloomberg Deals. I'm Matt Miller in for Danny Berger. Earlier today, Alex Kelly, global co-chair of M&A and private equity at Latham & Watkins, sat down with Danny at Super Return in Berlin to discuss the deal-making landscape.
It's important to just take a step back and think about where we are in the M&A market and just contextualize it for a bit, right? So first quarter of 2026, we saw global M&A deal volume go up to $1.2 trillion, a 25% increase over where we were at this time last year. But we saw deal count actually drop by 15%. And so what you're seeing is some mega deals that are really propelling the M&A market going forward. And it's interesting, if you look at that $1.2 trillion, half of that was actually 48 M&A deals that were over $5 billion and more. And so you're seeing a lot of high conviction strategic M&A transactions and even some private equity that are big ticket items where high value, large numbers, but you are seeing some stagnance in the mid-market.
See, that is interesting that private equity has been active in some areas. I think one of the latest statistics I saw was overall for PE, volumes were down something like 20%. But maybe it's just because it's only the big going. What does it take to get the rest of sponsors participating in this M&A boom?
Well, I think if you actually look at, Q1 of 2026, private equity volume was up 9% year over year, and deal count was relatively flat. And so there are definitely pockets of the market that aren't doing as well. But overall, I think we're seeing a rebound, particularly when you look at where we were in 2024. So 2024, all-time 5-year low for private equity. And then we saw a resurgence in 2025, up 50%. And we think we're going to continue to see that into 2026. And why do I think that? Number one, fundamentals are still there. There is a ton of dry powder out there. Financing is available, and you have these private equity sponsors that have a massive backlog of assets that they need to monetize. But what I've actually found that's been interesting, and I've been hearing it more and more from clients in the last couple of weeks, is that there's this growing sentiment that volatility and uncertainty are here to stay. So it's almost an acceptance that this is the new normal, and there's a growing reluctance to sit on the sidelines and wait around for perfect conditions, because folks are realizing there's a real opportunity cost to that. So I'm seeing more and more clients sit back and say, I think I'm ready to move into this market, even though it's not perfect.
Interesting. Is that across asset classes, or do you think, I mean, software to be really specific, that software remains just frozen at this moment for deal activity?
I wouldn't say it's frozen. Is it slower than other sectors? Sure. Is there more reluctance? But what's interesting is I have a lot of private equity clients that invest in the software sector, and what some of them are saying is it's actually an opportunity because there's a lot of folks that are more reluctant to get into the market right now. So they're trying to kind of flip that script a little bit and really focus on buying opportunities where they see that there's a strategic value add.
By the way, how much of your business has started to revolve around the creative liquidity solutions, if you will, around continuation vehicles, around secondaries? Are you seeing a lot of volume there?
So much of the capital markets and capital products have evolved in a way that's super, super exciting, right? When you look back 10 years, private equity was thinking, well, we're going to IPO, or we're going to sell to a strategic, or we're going to sell to a sponsor. And today, there are so many options. And it's interesting you bring up secondaries and continuation vehicles, because I think that is actually the one thing that is going to propel the private equity exit market in 2026 and beyond. So it's actually fascinating. If you look at 2025, there was $240 billion of secondary transactions, which itself was up 50% year over year. If you look at 2013, there was $26 billion. And so you're seeing a 10x increase over just about a decade. And it's really interesting because it's not just coming on the GP side, it's LPs and GPs. So you're seeing LPs, half of which are pension funds, using secondaries to rebalance their portfolios, to get liquidity, to solve allocation issues. And then, yes, you're seeing GPs in a continuing amount of the market come in and use continuation vehicles to hold on to assets that they don't want to sell at what they see as a depressed valuation while giving the LPs some liquidity. And so that is going to continue. That sector is going to grow, and you're going to see fundraising continue to grow. And I actually have been seeing in the asset management M&A side of my practice a real push for large asset managers to make sure they have secondaries platforms.
Well, I actually wanted to ask about that part of your business in particular, because I know you oversee it, and it feels like there's always a conversation at Super Return if we're going to see some real consolidation within private equity managers, within private credit. Are you getting that flavor? Are you also hearing noise out there that there's some people who are seriously looking at consolidation in this industry?
Absolutely. Consolidation is a trend, and it's continuing. So GP, minority deals, and control deals up 40% year over year. And even into 26, we've seen some big deals. And I can tell you, just looking at my docket and what's in the backlog, there might be some big things coming. And so it is an area where we're seeing a lot of consolidation because you have these large asset managers that want to scale, they want to grow AUM, they want to go FRE, and they want to aggregate talent. And they want to diversify their products, and they want to diversify their geographies. And oftentimes, folks think the easiest way to do that is to buy instead of build. But then you have it on the other side, too. We're in a fundraising environment that is favoring the large. 60% of all LP capital last year went to 6 managers. And so even fantastic middle market, lower to middle market managers aren't really able to fundraise in the way they could, and they see the value of going onto a bigger platform and getting more capital to invest in their businesses and just being part of a bigger organization. So we're seeing sort of push-pull factors on both sides that are creating a perfect environment for more consolidation. So prediction for end of 2026 into 27, absolutely going to continue.
By the way, I know you can't give us names, but what does it look like, I guess? Is it funds that want to be, that come together and just automatically be the size of one of the big public platforms? Like you need to consolidate and try to achieve a Blackstone or an Apollo or an Ares side. Is it that level of consolidation? Is it mega deals that we should be expecting?
I think for the most part, what we've been seeing and what I would expect to see is larger managers building onto parts of their platform that they're weaker in. And so it's not necessarily McDonald's buying Burger King, but it's sort of McDonald's buying a smaller fast food franchise in one state that it doesn't have many McDonald's in, right? So that's where I think we're going to go in the future.
And that was Bloomberg's Danny Berger speaking with Alex Kelly from Latham and Watkins at the Super Return Conference in Berlin. Coming up, Super Micro shares still under pressure after making a big announcement that will dilute shareholders. We'll take a look at that next. This is Bloomberg Deals. This is Bloomberg Deals. I'm Matt Miller. Super Microcomputer is seeking $7 billion in an equity deal for AI equipment. They'll then use those funds to purchase or to build their servers, and they have a ton of orders for them. Here's a report. Here to report on that story is Bloomberg's Anthony Hughes. So this is not dissimilar to the Google story we had the other day. They were going to raise $85 billion, right? It's diluting the current shareholders, which is why we see the shares selling off today.
Yes, well, the way I'd put it, Matt, is that the offering is similar in structure to the Google offering last week in the sense that it has the sale of common stock, the sale of a mandatory convertible preferred, which is a equity-like instrument that converts into equity in 3 years. And there's also a larger ATM or at-the-market offering where they'll dribble out the stock in the third quarter. And that's very similar to what Google did last week. The difference here is that this is at $7 billion, this is a large portion of Supermicro's market cap. So it's going to be around 30% dilutive. They've got all these orders coming in, so that good news sort of offsets the bad news of the dilution. But the stock's still down 18% today. Google raised $85 billion for a multi-trillion-dollar company, so for them it was about 2% of outstanding. So it's similar in structure, but the dilution is completely different.
So Supermicro, they make the servers, they make the racks that hold these GPU, TPU, or whatever chip processing units to power AI data centers, right? And they have orders for billions, tens of billions of dollars of those racks.
Yeah, so the company's saying in recent weeks they've had orders for, believe it or not, $39 billion worth of these AI servers. And if you remember this company, it really sort of rode on the coattails of NVIDIA over recent years until it hit hard times in the last year or so. Now it's sort of getting back on a more even keel, but this obviously sets back the stock now. But yes, I mean, we're really seeing this sort of AI capex explosion really play out in a number of stocks and companies like this. And we're seeing that they really do need to raise money and equity because these companies really want to do this in a way that doesn't overly stretch their balance sheet and it ensures that they can do this in a way which is more prudent, I guess, compared to like raising a whole bunch of debt, basically. Or right. In some cases, they may not be able to raise as much.
Well, I mean, raising $7 billion and I guess shareholders only taking, what, a 10, 15% hit isn't the worst that it could have been.
Yeah, well, I think it's a big hit for the company, but I think they were hoping that the news about the AI orders would sort of offset the bad news of the dilution, and it hasn't. It has to some extent, but not completely.
Not fully. All right, Anthony, thanks very much. Bloomberg's Anthony Hughes covers these stories for us. Reminder to stay up to speed even after the show. You can subscribe to the Bloomberg Deals newsletter. Up next, Balance of Power coming up. Live from Washington, D.C., this is Bloomberg.